Unit 2, The Economy, Lecture 4, Business Cycle Phases. All economies experience cycles in economic activity. These are recurring intervals of economic expansion, followed by times of recession. These cycles are termed business cycles and are defined as recurrent but non-periodic fluctuations in the general business activity of an economy. Now, each cycle consists of 4 phases. You have a lower turning point or trough. This is when the economy has bottomed out in terms of the recession. You have an expansion. This is when you have a recovery in economic activity. You have an upper turning point or peak. This is essentially when the economic recovery has peaked, so economic activity has peaked out. And then you have a contraction. And this is when the economy goes into recession or decline. In this slide you have a graph of the various phases of a business cycle. Now, because we are interested in financial markets, we are interested in how the business cycle, the various phases of the business cycle, influence the financial markets. So if we look at one, this is where we're coming up into an economic recovery. There is low economic activity, low interest rates, and what that means is that consumption should be stimulated and there should be strong demand. But unfortunately at this stage, investors don't recognize this is beneficial to them. As we have the economic recovery increasing, there will be a strong growth in earnings, and investors will recognize this and react rather enthusiastically, which will cause the financial markets to increase. Now, as we reach the peak and the cycle turns, demand in the economy will start to come under pressure. There will be inflationary pressures, which means increases in inflation, and this will have a knock-on effect on interest rate, increase in interest rates. But it seems investors will still react enthusiastically, not realizing that they've actually reached a turning point. As you move down, you get to the bottom, the economy will become stagnant, earnings will disappoint, and investors will become negative and realize losses. They'll move their money back to the money market, and this will have a negative impact on financial markets. And then the whole cycle moves back again to one where investors won't be interested in financial markets and will remain in the money market. Now we're going to focus on each of the various phases of the business cycle and what that means for the economy, and we're going to start with the expansion phase. So the expansion phase is when the economy is in recovery. What this means is that aggregate demand will increase, firms' inventories will run down, production will increase at a faster rate than aggregate demand as inventories are rebuilt, and business will employ unemployed workers, so the labor market will start to improve, who spend their income on consumer goods. This generates more demand and businesses employ more people. So as the expansion phase continues, the process will continue until business encounter capacity constraints. So essentially the process of producing more goods and services will continue until businesses realize that they don't have the plant size, the equipment they need to increase production. If firms expect continued increasing demand, then they will invest in capital goods, such as plants, factories, machinery, and equipment. Consumer demand will increase on the back of the increased demand for capital goods, as firms producing capital goods employ more labor. In addition, there'll be an increase in the demand for investment funds. But an expansion phase can't last forever, so eventually the production will reach a ceiling due to supply constraints and bottlenecks, and we will reach the upper turning point. The demand for investment funds will put pressure on interest rates, thereby increasing interest rates, and new investment will no longer be profitable. So now we're moving into the contraction phase. This is where economic activity decreases and the economy moves into recession. So as investor demand or investment demand falls, producers of capital goods will lay off workers. There will be increased unemployment, and this will result in decreased consumption spending or consumer spending. Businesses producing consumer goods and services will cut down on production and employment because there's no longer a demand for their goods and services, and the contraction or the recession will gain momentum. So much as the expansionary phase could not continue forever, a recession or contractionary phase cannot continue forever, and eventually the recession will reach a trough or lower turning point when production decreases to some minimum level. At this level, consumer demand will remain steady as workers employed by the government or in industries producing essential goods and services, such as food and utilities, retain their jobs. So as a result of the fact that there was poor demand for investment funds, this would have had an impact on interest rates, which would have fallen at this point. And so with lower interest rates, it would make new or replacement investment profitable again, at least for firms providing essentials. And this is where the economy will start to move up again, recover. With steady consumer demand, an increase in investment demand will begin to lift the economy again. So essentially, the Merrill Lynch investment clock summarizes, using an actual clock, the phases of a business cycle and the assets that would be most attractive to invest in during those phases. So now we're going to look at how the different asset classes perform during the different phases of the business cycle. Looking at shares or equity, they tend to perform best during both the recovery and expansion phases. And this is because as the economy goes into recovery and as it starts to expand, there's an increase in the demand for goods and services. There is also an increase in investment spending, and all of this contributes to an increase in company profits, which is good for shares. But as you get closer to the peak, so as you get closer to the top of the cycle, profits are starting to peak and investors become less certain about what's going to happen to the profitability of companies. This lack of certainty shows up in the volatility of share prices. So during the contraction phase of the business cycle, when economic conditions are deteriorating and corporate profits are falling, share prices will decline. Bonds are likely to perform best during the contraction phase and the lower turning point, because when interest rates are declining, bond prices are rising. Bond prices or bond values are inversely related to interest rates. So higher interest rates mean lower bond values, lower interest rate mean higher bond values. So during the contraction phase, when interest rates are low, bonds will perform best. As we've previously mentioned, bond prices or bond values are inversely related to interest rates. So when interest rates are high, which tends to happen during the late expansion phase and upper turning point, bond values will be low, so bonds will tend to perform less well during these phases of the business cycle. With property, it tends to perform well during recovery and expansion when interest rates are relatively low and employment and economic conditions are improving. Since commodities tend to be inputs into the production process, as the economy goes into recovery and as we go into the expansion phase of the business cycle, demand for goods and services are increasing, and when companies are increasing their production, commodities are likely to perform well because there'll be a high demand for them. Commodities don't perform well during contraction because manufacturers are cutting back because there is less demand for goods and services, so they're reducing their production capacity. as they go into a contraction. So precious metals such as gold and platinum and silver, which are used as a hedge against inflation, tend to perform best during the upper turning point when inflation is actually quite high. So during the contraction phase, when inflation is low and industrial demand is low, precious metals won't perform as well.